With a health savings account, you can pay for eligible medical expenses with tax-free dollars. But what happens if you use your HSA funds to pay for an ineligible expense? Well, the answer is that for account holders under the age of 65, if they spend their HSA money on ineligible expenses, they'll owe taxes on that money plus a 20% penalty on any amount withdrawn that exceeds their eligible expenses. So for example, if a total of $500 was withdrawn from an HSA during the year, but the account holder only has receipts for eligible expenses totaling $300, then that HSA account holder would report the $200 excess deduction as taxable income and then pay a 20% penalty or an additional $40 on the excess withdrawal. Previous expenses that were incurred after the HSA was established but were paid out of pocket with after-tax dollars can be used to offset that taxable amount though. For example, let's say Susie has an HSA qualified plan in 2018 and she set up her HSA account. She goes to the doctor and the bill after the insurance discount is $100. Instead of using her HSA funds for that expense, Susie pays the $100 doctor bill with after-tax dollars using her regular debit card, and she hangs on to her receipt. She puts it in the file folder with all of her other receipts for HSA qualified expenses. Later on in 2019, she can use $100 of her HSA funds on whatever she likes. Even if the expense is not eligible, the prior eligible expense that she paid out of pocket with tax-free with after-tax dollars can be used to offset the ineligible HSA expense. There are no penalties, though, after age 65. Once the account holder reaches age 65, the penalty goes away and the HSA functions much more like an IRA. Any funds used for ineligible expenses will be taxed, but they will not be penalized. Of course, any funds used for eligible expenses are always tax-free.